Now, the way my employer worked this, they actually paid a lot more on my housing subsidy than I was entitled to on the exclusion. So what some employers would do is they would just lump that into your income and you'd have to pay tax on it. Most oil companies, which is what I work for, would not do that. What they did is they grossed up your salary, they paid the additional tax for you on your behalf, so I got away with it like free. So it was a very, very nice deal. So, and that's the way oil companies work. Now, if you work for some other kind of business, it may not be that generous. So, but as far as the U.S. tax is concerned, this is so the foreign tax credit. Now, this is in answer to your question. Let me describe basically how this works. In fact, let me start with a very simple example. A very simple example is you're living here in the U.S. and you've got some foreign investments. Let's say you have an investment account with Fidelity and you're invested in some foreign stocks. And the foreign stocks are paying tax to the foreign government that the tax is in. That foreign tax, let's say you pay $100 in foreign tax. That foreign tax gets to come off of your U.S. tax liability right off the top. So let's say your U.S. tax liability was $1,000. You had $100 being paid out to this foreign tax for your investments. $100, that $100 comes off. So now it's only $900 you pay U.S. tax. Let me tell you now. Let me put it another way. Let's say, for example, you were working in a country whose tax rate is lower than the U.S. So let's just pick a number. Let's say that your U.S. taxes are 25%. You're working in a country where that country's tax rate is 20%. So you're paying that country's tax, the 20%. Now you get to take all of that off of what you would pay in the U.S. Just like the simple example I just told you. Comes right off your U.S. tax liability. But let's say and so then you would still have to pay some U.S. tax, right? Whatever's left over. So in the example I just gave, the country you're living in is 20%. Here is 25%. Well, you get to subtract your 20%, so now you're just paying 5%. See how that works? But now let's say you're living in a country where the tax rate is higher than the U.S. Here you're paying 25, there you're paying 30. Well, that 30% comes off, it reduces your U.S. tax liability to 0. You don't get any money back. So, I mean, if you choose to live in a country that taxes more than we do, heaven help you, but that's actually when I was living in Indonesia was taxing higher than the U.S. So, yeah. Right. Yeah. I'm not so sure it is anymore. I'm not sure. I've lost track of it.
Still progressive.
It's still progressive? Okay, so that's...
Is there a limit on the credit? You can actually get it down to 0? Or
you can get it down to 0. Yeah. So the foreign tax credit is limited only to the part of your U.S. tax that's in proportion. This is a very complicated way of saying what I just described to you. This is right out of the tax code. So, I think I explained it a little easier than that. So, what's that last one? So this is the limitation, Christine. The allowable foreign tax credit can't be more than your actual foreign tax liability. So, say for example, well, this would be in a case where your foreign tax is at a lower rate than the U.S. tax. Your foreign tax is at 20%, U.S. tax is at 25%. You can't take any more than that 20%. Oh, and let me go back to that one. This kind of addresses the other question that was asked. If there is some credit off, let's say we're talking about Indonesia. If you're getting some kind of a credit in Indonesia for paying U.S. taxes, and it reduces your Indonesian tax, the only credit that you can take against US tax is what you actually paid to Indonesia. If that makes sense. So I mean, you know, that's after any of the other credits have been subtracted. Okay, foreign tax deduction. Foreign tax deduction is similar to the credit, except now the deduction is being subtracted from your taxable income. Now, in general, credits are better than deductions. Why? Because credits come right off of your tax liability. Deductions come off of your taxable income, and then the tax liability is calculated. When would it be better to take a deduction rather than a credit? Because you can't take both. When would it be better to take a deduction? When you're living and working in a country with a tax rate higher than the US. Now you take that full amount that you're paying. Let's say you're living and working in a country that's taxing you at 50%. Well, you take that whole amount and you that large amount of dollars, subtract that from your taxable income, and now that reduces your US tax liability. That may be better for you. Your tax accountant should work it out both ways, because you do have a choice. You're not forced to do one or the other. You can take your choice. Generally, the credit's better. And if there's any reason that you cannot take the credit, you could take the tax deduction. So these are things I've already said. I've already described that. Okay, so now let's kind of, if you don't have any questions on foreign issues, now I'm going to talk about our taxes that we pay right here now.
So this foreign issue is applicable for resident, non-resident, right? So if you invest your money outside, you still got this payment.
Yes. So if you are a resident, a U.S. resident for tax purposes, and you have a business that's making money in another country, the earnings that you get from that business are taxable by the U.S. And that income, all of those foreign issues that I just described apply to that foreign income. So I'm assuming that if you have a business in Indonesia, you're paying Indonesian tax, and so you get a tax credit against that income that was earned overseas on your U.S. taxes. So it wouldn't be a credit against all of your income, because presumably some of your income is in the U.S. I mean, if you're living here, if you're a resident. But if you follow what I'm saying? Now let's take a look at your paycheck, just in general. On your paycheck, you have gross pay. This is, usually if you go to work for an employer, they say, I'm going to pay you, $150,000 a year. Okay, well, you ever see $150,000 a year? No, because they subtract withholding tax for your income tax. They subtract FICA, which is your Social Security tax, and they subtract Medicare tax. And then you get the net pay. Back up a bit. There you go, net pay. So let me go through these numbers a little bit. FICA, sometimes you'll see, if you look at your pay stub, sometimes it'll say FICA, sometimes it'll say OASDI. OASDI stands for Old Age Security and Disability Income. What they take out of your check is 6.2%. Your employer also pays 6.2%. Up to $128,400 in 2018. So it keeps going up. After you earn above that amount, no more Social Security tax is taken out. Medicare, sometimes it's abbreviated HI, stands for hospitalization insurance. That's 1.45% taken out of your check, and there's no cap on that. You could earn as much as Donald Trump, and still they take out 1.45%. Okay? And if you do make a lot of money, over $200,000 or $250,000 if you're married filing jointly, they'll take out another 0.9% to help fund Obamacare. So that's the extra. when you're my age and you're on Medicare, it's great. And I thank all of you for paying for it. But I paid for it for a number of years.
So the Medicare is for everybody? Okay.
Yeah, but it has to be, what is it, 60?
Everybody, your income?
65.
60.
But you got up, the income has to be less than a certain age, no?
That's Medicaid.
Oh, that's Medicaid. Okay.
But for Medicare, you have to have paid this for 40 quarters.
Yeah.
So if you haven't worked in the US for 10 years, by the time you're 65, let's say you move here when you're 60, you still wait for, you still need to wait until you're 10 years.
You're paying, but you don't.
Yeah, the 10 years is for Social Security benefit. Medicare, I think, is a little less than that. I'm not totally sure what the number is. It might be 10 years. I don't remember exactly on Medicare. Social Security is definitely 10 years, like you said. And you can't get a partial amount. Now, here's an interesting thing, and this is just a side note on Medicare. Let's say, for example, you work in a industry where you're not paying into Medicare tax. Like, for example, public school teachers or state governments. You may not be paying into that system. Well, then you're not going to get Medicare. You're going to get whatever that provide, whatever that entity provides. So, just be aware of that. Anyway, so that's what your paycheck looks like. Now, I just want to hit this real quick. This is something that, for me, every time I hear somebody misuse this term, it's kind of like somebody scraping their fingernails on a chalkboard, It just drives me nuts, because people think that a tax return is the check that you get back from the government after you file your taxes. That is not a tax return. That's called a tax refund. A return is a legal term. It is a legal term. And what a return is just a document. And throughout the legal profession, I've learned this, not from being an engineer, not from being a tax preparer, but just from reading up. The term return is used in all kinds of areas in the legal world. A return is simply a report. So when you fill out your 1040, that is your report. You're reporting to the government how much money you earn and what your tax liability is. That is your return. Everybody's required to file a return, whether you get a refund or not. You got to file it. So that's what that is. And yet I hear people, politicians, news commentators, people who should know better, misusing this term. Don't misuse this term. Now you know. Anyway, so now let me just show you how the basic income tax calculation works. There are basically 3 types of income that are taxed, and they're all taxed a little differently. Earned income, which is like your salary, wages, benefits, your bonuses. Portfolio income is from your investments, dividends, capital gains, and then your passive income. That could be like from limited partnerships, rental income, and so on. All of those things get added up together to give gross income. Now, each one of those types of income has a little different tax treatment, and so in your tax planning, in your working years, you want to try to create for yourself in retirement a portfolio where you're taxed on capital gains rather than regular income tax. Or if you're putting money into rental properties, that rental property is passive income, you don't pay Social Security tax on that. You don't pay Social Security tax on your portfolio income either, only on your earned income. So anyway, once you get your gross income, you can subtract adjustments. There are certain adjustments that are allowed. Subtract that, and you come up with adjusted gross income. You've probably heard that term thrown around a lot. That's because the adjusted gross income is one of those numbers that's kind of like a pivot point for a lot of other calculations of credits and additional taxes. It's all based on adjusted gross income. Then from that, we can subtract, we used to be able to subtract personal exemptions and deductions, either standard deductions or itemized deductions, in order to get taxable income. Now let me stop here. Last year when you filed your taxes, you did have something called exemptions. Do you know what exemptions are?
Yeah.
Okay. And now from this point on, or at least until the year 2025, there are no exemptions anymore. They've been done away with. So you don't subtract that anymore. In its place, what the government did is they increased the standard deduction. They almost doubled it. And the effort was to simplify the tax code. My personal opinion, I don't think it simplified anything, but the politicians think they did, so God knows them.
It basically penalized the big family then.
Well, you would think so, but no. And I'll get into that in a minute. They for families, they made up the difference in the child tax credit. They doubled the child tax credit, and they also increased the limit before phase-out begins on the child tax credit. And in addition, I'll wait till that slide, but there's even more good stuff. So yeah, it's good. So then you get taxable income. From this point, you calculate your tax from the tax rate schedule, and you either subtract tax credits like the foreign tax credit, education credit, other credits, any payments you might have made, estimated payments you're withholding, all that gets subtracted. And then you might add some additional taxes. If you're self-employed, you add self-employment tax. You might have other penalties that have to get added. And then you come up with either your tax due or the refund. You have a tax due, you have to write them a check, mail it in. If you have a refund, they send you a check. Okay? So that's the basic calculation. So when we're talking about things like credits, this is where the credits enter into the picture. Taxable income has already been established, the tax has already been calculated, and now you're subtracting that from the tax, right? Deductions come over here. Deductions get subtracted from adjusted gross income in order to get taxable income before the tax is calculated. So you see where that difference is. Is it subtracted before I calculate tax or after? That's the difference between a credit and a deduction.
So basically, if your tax rate is 35%, then $100 worth of deduction is the same as $35 worth of credit.
Correct. Exactly. Yeah, and that's a good way to do that. Since we're on this, let me just illustrate this a little better. Let's say, for example, I have this every year. Clients are trying to squeeze out the last little deduction possible from their tax return year, and they're looking through all their receipts and trying to scrimp and save and whatever. And I say, well, okay, all this effort you're putting into it is only going to save you the amount of your marginal tax rate. So like Christian just said, if your marginal tax rate is 35%, which is the next to highest tax rate right now, if you were at 35%, that means that for every dollar you save in a deduction, you only save 35 cents in your pocket. That's all that means to you in your pocket. Most of us aren't in the 35% bracket. If you're in the 25% bracket, it's only saving you 25 cents. If you're in the 12% bracket, like a lot of my clients, it's only saving 12 cents. Don't waste my time. You see? So that's, and the other thing, this might not be very nice, but believe it or not, most of your tax preparers, especially CPAs, will charge you time if they have to sit down and add up all of your receipts. Go prepared when you go see your tax preparer. It'll save you money. A lot of them won't charge you, but most of them will.